Hello, today is December 8th, 2018. We had a few calls. We said that this rally should continue even if only for a small amount. At work, prices and futures were down when I made the call. They dropped further, but by the time we opened, we did continue the rally a bit further, retracing all of this drop. We said that this low should hold. We had a huge drop, but the low did hold, so that worked. Looked for the pattern with the early low, which we got. During the day, MEJT said this is a false move, gives us a target of 26.5726, most likely by Monday's close, and that's my call. As always, gapping down smartly kills the call before the open. When you have a big drop like this, especially on a Friday, you want to see follow through, but at the close, we could not close under the middle of the day low. It's a positive pattern, unless we invalidate it by gapping and promptly taking out this low. Monday's pattern is the one with the early low, tends to have a late high, tends to be an all-day rally. If it is a negative day, tends to be a big drop in the first 1 to 2 hours. For the reasons I'll discuss, what I'd like to see Monday is gapping up, retracing and making a low either at the end of the first hour or more likely at the end of the second hour of trading, and then rallying all day and hitting this price. Here's our trend line. We've dropped right to it, but not through it. The rule is when you drop to a trend line and don't go through it, you either gap under it or the trend line wins. It's been hit so many times, eventually we're going to break through. Doesn't mean we have to break through right this minute. This is a long-term chart. It shows how this consolidation has a Fibonacci relationship to this consolidation. Here's your high, here's your 38.2. You measure from here to here, you get this low. You measure to the top, you get this low. And if you measure to this high, you get Friday's low. So they really all are related. Now this was the count I've shown. It doesn't break any rules, but wave 2 and wave 4 usually aren't the same in character. It isn't a hard and fast rule, but when you see them looking exactly the same, you have to suspect it's not the right count. Here, wave 4 is very different in character than wave 2. It's a count more consistent with something that one normally sees. And note there is a relationship at the low. While we've been hitting all these lows, the number of stocks with positive patterns keep going up at a steep level. That means fewer and fewer stocks are participating in the decline. Fewer and fewer stocks with negative patterns are pushing the markets down. Usually it leads to a rally, and if it's the end of wave 1 down, as is plausible, you would expect the wave 2 to have some kind of magnitude comparable in size to wave 1. Regardless of what count one has, and there are various counts that work, trying to expand this. Here was your low that I thought would hold. You've got a clear 3 waves up. You've got a clear 3 waves down. That's B. It shouldn't shock anybody if we have a wave C up from here, regardless of what the count is. Now the standard rule applies. If we gap smartly in the undesired direction, which is down, all this gets killed before the open. And frankly, if we just traded a little closed, I'd be suspicious that this wouldn't print, but I would stick with it, not certain how much money I'd risk on it without more information. But the ideal situation would be gapping up, rejecting this decline, dropping again, hitting a low either at the end of the first or more likely second hour of trading, and then rallying throughout the day. Here's my target. Gapping down smartly kills it, and that's today's call.